Hello, Professor Hanke. Thank you for
Good
joining
day.
us today.
Good to be with you.
What's wrong, what's going on, with China's stock market and economy, Professor Hanke?
Well, first, the stock market. There are actually three stock markets in China, and they've been wildly volatile, going up and down by as much as 6% or more per day since the start of the year. And all of them are down over 20% in aggregate. So volatility and down in the stock markets. Now, this is related a little bit to another volatility issue, and that is the Chinese yuan, the currency. On bad advice from the IMF, as well as most economists around the world, the Chinese have decided to allow their exchange rate to become more flexible. And this has created a lot of volatility and uncertainty, and that's part of the stock market problem, because it feeds into the economy. If you get an exchange rate that's volatile in China, you get capital flight, and that puts downward pressure on money supply. And with the money supply growing at below trend rates, the economy starts slowing down. So that's the economy side of the picture. So it's very tangled up with the exchange rate. Bad advice, really, that the IMF has given the Chinese, and the Chinese have bought into it. In 1994 to 2005, the exchange rate in China was completely fixed, the yuan to the dollar, and that was the most stable period they ever had. Fast growth, low inflation, great stability with a fixed exchange rate.
You gave us such a nice overview of what's happening on the market in China. What is the main reason for China's market mess?
Well, I think, of course, you've got the exchange rate volatility, which I've mentioned. That is a big factor. The second thing is that there's been a poor implementation of a number of regulations in the stock market, like the circuit breaker fiasco that they had. And the third factor is very important, and that's what I call the big players problem. If you have big players involved in a stock market or a bond market, that means a central bank, a sovereign wealth fund, friends of the government, like in China, all the state-owned enterprises and so forth. People stop looking at the fundamentals of the stocks that are trading on the exchange, the free cash flow and balance sheets, for example, and they start watching what the big players are doing, and they move away from fundamentals. And so that's what the market is really not based much on fundamentals anymore. It's based on what everyone's guessing the big players will do next. So there tends to be a lot of herding behavior and a lot of volatility associated with the big player problem.
Thank you for being so.
Thank you very much, Professor Hanke.